simpler perspective as to what is private credit. Private credit is basically lending to corporates. Fundamentally, credit funds are closed-ended funds for investors. That's the horizon that they have to take. That these investments that are making are for 3, 4, 5, 6 years, depending upon the fund to fund that they investments. There isn't a leverage or there isn't a additional pool of capital that gets built on those commitments. So whatever you raise as a commitment, you basically deploy it. I think similarly, there are a lot of permissible lending end uses that only central banks allow you to do. I mean, there is a large part of it which banks are not supposed to fund. All that also comes and sits with your private credit funds.
Okay.
These are collateralized form of lendings, like in Modulus that we do. We only do exclusive collaterals. We ring fence the cash flows, which is what the credit fund industry by and large also do from an India context. I think we are broadly at the, we have sort of done with the rate hikes and we have peaked out from a rate capacity. We've sort of the recent the global commentary from a macro perspective also, where we are in an elevated interest rate cycle. I think, and I think anything that you sort of invest today in bonds and in fixed income on a downward slope when the interest rates go down, it's whatever time period that we have, 12, 18 months, I think there is money to be made. So it's no brainer that, at this point of time, one should sort of invest in bonds and have a higher fixed income allocation.
Hello, everyone. Welcome to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I'm the founder and CEO of Daulat Wealth Management. Today, we are pleased to be joined by Rakshat Kapoor, CIO of Modulus Alternatives. Modulus is an established alternative asset manager in the Indian private and performing credit space. Since its founding in 2018, it has invested over 2,300 crores of investor capital, returned in excess of 1,000 crores back to its investors, made 20 plus successful investments, and have had zero defaults till date. Rakshat is a credit veteran in India, having over 24 years of experience in managing credit investments, working with some of the biggest financial institutions like Nomura, Deutsche Bank, and ICICI before founding Modulus Alternatives in 2018. He is a qualified chartered accountant and holds a bachelor's degree in accountancy from Delhi University. Rakshat, it is an absolute pleasure to have you join our show today.
Thank you so much, Varun. It's a very great introduction, and it's great to have been talking on your platform to your audience.
So Rakshat, we just want to get started with the basics for the benefit of our audience today. What exactly does private credit, performing credit mean in the context of investing, whether we are looking from an alternative point of view?
Sure. So, see, private credit has of late has gathered a lot of media sort of attention, and there have been a lot of credit funds that are now sort of operating in India. But just from a very simpler perspective as to what is private credit is basically lending to corporates. And historically, that business has been predominantly from an Indian subcontext, has been sitting largely with banking industry, para banking, which is NBFCs, and some part with asset management companies in mutual funds. But because of various reasons, which is that credit is a lot more specialized activity, and the certain kind of nature of risk that is sitting with private credit, the managers who manage some of these dedicated funds are better equipped to handle this more specialized form of investing. And but in very, as I said, simpler terms, it's basically lending to corporates, and that's where they are dedicated private credit funds.
Okay, so just as a layman trying to unwrap what you just told, effectively today, as I was just reading prior to our podcast, approximately 75% of the funding market is still dominated by banks, NBFCs, housing finance companies, and the remaining is basically mutual funds, some corporate bond market, right? So if I were to unwrap that correctly, you effectively lend to companies who are, for some reason or the other, unable to tap that bank market or the NBFC market and comes to a private credit manager like Modulus to come and raise funds, right? What makes you comfortable to lend them when the banks or NBFCs or the investment grade market are unable to provide them capital?
Sure. So you're absolutely right that as India has been, as I said, that largely the credit investments or the credit risk is really sitting with banks, etc., which has been our historical predominant position in India. But what is happening is that if you look at banking sector today, I think there's certain recalibration of risk that's happening within the banking system, which basically is that there is a certain kind of risk which is banks are a lot more focused on taking shorter end of the curve risk, which is short term duration financings, working capital, supply chain, trade finance, bill discounting. While I think the longer end, which is more like I would say project loans, or sometimes when corporates sort of go through a little bit of macro issues or certain capex decisions doesn't go well, or certain end use certain requirements that corporates have. I think all of that is really sort of sitting really today in funds, and that's the reason that why this the entire credit fund segment is growing. So just to sort of let's take an example. So if you look at a company, right, your day-to-day needs for a corporate are really being met out of your working capital, which is what the banks are still doing it very actively. Having said that, sometimes, as I said, that because of certain macro factors, right? I mean, you saw COVID happen, right? So when COVID happened, what really, for some of the corporates, the working capital cycles really got elongated. There was a point of time where probably the revenues were not in line with what your debt repayments could have been, or whatever your debt obligations are there, or general, the payment cycle of corporates. At that point of time, I think banks find it really difficult to sort of step on the pedal and still continue lending. So at that point of time, while there is a good company, there is a good business, there's a solid business model, there is a historical good performance of a company. But at that point of time, I think banks, as I said, find it difficult to lend, and that's the reason that companies basically go to these credit funds. Now, that does not mean that credit funds are basically taking more risk. What banks are really doing it, banks are credit funds are a lot more specialized shops, as I said. So they're dedicated credit managers who probably would look at things more from a deep dive perspective. Take an analogy in the form of a small cap versus large cap equity. What is a real difference? I mean, I think when you buy a small cap or a mid cap or a penny stock today, I think there is a heightened diligence. There is more specialized way of looking at how a small cap corporate is. Similar to that, when you look at a corporate at the time, the example that we took, at that point of time, you probably will have to look at from a different lens. You probably will have to structure the risk, which sort of insulates, or I would say mitigate a lot of that risk by taking much more cash flows, ring fence in the form of your security. So it's a little bit form of a specialized lending, which is what a dedicated credit fund is supposed to do, and which in a larger framework of a bank finds it getting difficult to get absorbed. Second is, if you look at, I think the way banking sector has also been recalibrated globally. I think there are a lot more regulatory, much more regulatory scrutiny that has come. There's much more capital that is required, more provisioning norms. So because of all this, I think there is a certain category of risk that banks are a lot more comfortable taking, and banks are being encouraged by the central banks of the respective countries are taking. And as a result, in any economy, there is the sheer size that is there today. Look at in India, for example, there is a size of economy that prevails, which at times and at certain life cycle of these corporates, they do come out of the banking system, go to credit funds, borrow money, realign their cash flows with their capital structure, and then in about 12, 24, 36 months, go back to the banking system. So I think that's what the private credit is all about.
Okay, so I think you made a very interesting point, but just to summarize that for our audience, effectively, if you are going and borrowing from a bank, I think a more plain vanilla lending structure over there works, where there is a monthly amort. That is partly also because the borrower profile or the asset liability mismatch, as we would like to call it, where banks effectively borrow short and lend long. That is a model that we have seen in the West, typically did not really end well with the bust up of the two banks that happened in the US last year. And that effectively the risk is being distributed from the banking system from the borrower, from the lender, from the depositors, sorry, to the investors, right? And that is where specialized credit funds come into the picture, and that's what we're seeing happening in India,
Oh,
if I were to
absolutely.
put it
But Varun,
correctly.
just to sort of also add, it's not that credit funds don't, they don't have regular servicing of their cash flows. It is just that sometimes, the cash flows of the business gets realigned to your debt obligations. So I would not say entirely that, credit fund would probably just look at a very bullet type of structures where the companies pay at the end of 3 years, 4 years, 5 years. But it's just that the cash flow of a group, of a corporate gets realigned with your debt obligations. So that's the flexible solution, or I would say not flexible, but customized solution, which a credit fund, based on their analysis, can sort of make that or tailor make it for that corporate. And that is really called private credit investing. And it's
Okay.
not entirely that, if there is inability of a corporate to service its debt and then private credit is required, it's, that's just one very small part of it. Take an example. If a company wants to grow, right? I mean, there is a significant growth opportunity that a corporate has. How does it grow? You'll probably raise more equity and then grow, or you should have a lot of internal accruals that can support your new growth initiatives. Or at times, if the markets are not conducive in public markets, you probably go and take credit funds exposure for a temporary bridge. And whenever the pocket of window is there in terms of opportunity and even from your valuation re-ratings, I think that's another thing that private credit funds are supposed to do. Similarly, there are a lot of permissible lending end uses that only central banks allow you to do. I mean, there is a large part of it which banks are not supposed to fund. All that also comes and sits with your private credit funds.
Okay. So I
So
just want
just
to
to summarize,
okay.
so just to summarize, I think one, for an existing corporate, sometimes realignment of cash flows in line with what your current business projections look like. Second is how the growth is really happening in a corporate. At times that gets funded by the credit funds. And third is really about, sometimes the bridge requirements, etc. That, from a central bank, there are certain end use restrictions which you probably, banks are not able to fund, and you come to credit funds.
Okay. So I just want to contextualize what you just mentioned right now in the context of an investor who's coming and investing into an alternative fund, into a private credit fund, because obviously, prima facie, the perceived risk tends to be significantly higher. And that is why there is a cap of 1 CR, which the regulators have put for anyone who's willing to put into such funds. But as we just discussed, just because it is an alternative or a private credit fund, that does not mean it has a significantly higher level of risk. So, if you could just, for the benefit of our audience, throw some color, what are some of the key risks that are there that an investor should keep in mind when investing into these funds?
Sure. So first is the basic construct of an AIF is that, you raise commitments in a fund, you raise primarily your equity capital, and that's what exactly gets used in making your investments. There isn't a leverage, or there isn't a additional pool of capital that gets built on those commitments. So whatever you raise as a commitment, you basically deploy it. I think, and second is that these are closed-ended funds. Mutual funds are always open-ended funds, and that was the problem that sort of sometimes also it happened that, when mutual funds were trying to do credit investments, being an open-ended nature, your redemptions can come at any point of time, whereas the deployments has been there for a 2, 3, 4 year period. So fundamentally, credit funds are closed-ended funds for investors. That's the horizon that they have to take, that these investments that are making are for 3, 4, 5, 6 years, depending upon the fund to fund that they invest. Third is in terms of your specific question around your risk. As I mentioned that, these are specialized and dedicated shops that look at a specific corporate, and, you know sort of ring fences their entire exposure in terms of its investment in the form of your cash flows, in terms of your security, in terms of very tightly monitored covenants, credit conditions, etc. So I would not call it that it is a significantly higher risk of investment, but yes, this is credit investing. So any investor who basically would want to take or play the credit cycle, and as we see that there are fair bit of demographics that are favoring the growth in the economy, growth in the capex, etc. So that's the kind of investment that an investor should sort of look at. But from a special, this is like every investment really comes with some sort of a risks. So of course there is a risk that, let's say there is a fund, they make X number of investments, certain investments don't perform, certain investments do perform. And to that extent, then funds own charter in terms of how diversified they are, whether from a sector perspective, whether from a single investment exposure perspective, depending upon what category of risk they are taking. For example, within the credit funds also, there are certain performing credit funds. There are certain in funds which are focused on a little bit higher risk in the form of special situation funds. Or for that matter, there's another category of risk which is a lot more about around the distress side of it. So depending upon your risk profile as well, that's how the funds are available today in India. And the category of risk obviously vary with these risk that is or category of funds that are associated with it.
I think the single biggest question that investors typically always have is the credit risk. That when you're lending basically to corporates below the investment grade, what gives them that comfort that the capital is going to stay protected, that even in a rainy day scenario over a 4 year 5 year period, if things go absolutely south, they will at least have their capital protected? Or in other words, what are some of the risk mitigation measures that Modulus specifically takes to mitigate a credit risk or a liquidity risk?
So, so let's take an example. Let's say there is a corporate which makes a capex decision, and the capex. I'm just trying to address the credit rating part first. How do we assess risk and how we should look at from that lens? So let's say there's a company that makes a capex decision. The capex gets delayed, but the money that they've borrowed against that from normal project lenders starts coming to mature. As a result, when a credit rating agency looks at that corporate, they will look at the free cash flow that you will generate in this year, probably short on how your debt repayments are. So obviously your credit rating is not good, and in your case, let's say it's below investment grade. Now, where does the credit fund come in? What is the risk, and how does this risk gets really addressed in that example? So we continue to believe that this business is good, the business is strong, and it's just the alignment of cash flows that need to be there. So in that context, what happens is that credit fund will make that investments. As I said repeatedly, that some of these cash flows get realigned in terms of your repayment profile. These are collateralized form of lendings, like in Modulus that we do. We only do exclusive collaterals. We ring fence the cash flows, which is what the credit fund industry by and large also do. So what you are doing is you are really investing in a company which based on your analysis, but your diligence in terms of variety of factors, there's a solid business model and a lot of other things, sort of, realign your cash flow profile according to your repayments that were coming to mature. So to that extent, I think the risks really get contained. Risk also gets contained when you monitor your investments well. Like for example, in Modulus, I think we have a system of monitoring every month, every quarter, and every periodicity, so that you stay on top of your credits. The third, I think, as I said, we are doing fixed income eventually. So these are credit funds in which all the transactions or all the investments that you make are always collateralized. They're always backed by proper collaterals in the form of assets of the company, share collaterals, real estate, hard collaterals, etc. So one of the three or combination of three, etc., normally comes into place. So, from a downside perspective, I think from an investor standpoint, I think they are primarily investing in a credit fund. Credit fund is really about playing the credit cycle, and all these investments that you normally do, as I said, are very very thoroughly looked upon from a detailed dive credit angle and all collateralized form of lendings.
Okay.
So I would not say that some of these investments come with a very heightened level of risk, but yes, there is a moderate risk because the nature of risk at that point of time is probably higher, but that gets contained in the form of the type of investment that you do and the type of mitigations that you do from a credit conditions perspective.
Okay. So as we speak, Rakshat, obviously there is these beeline of fund managers who are lining up funds both domestically and globally and going after that big opportunity set that we just talked about in the Indian private credit space. Right? When we draw parallels to, let's say, from an equity investing point of view, let's say someone who has decided to invest it into a mutual fund or a large cap fund, the variability of returns could significantly be higher, let's say from a top performing fund to, let's say, the bottom performing fund, right? There is this big delta of returns, and that's obviously investors choose the funds which gives them the highest returns, right? If we switch sides and look at fixed income, obviously that is not the case. Obviously, the variability of returns could not be maybe like a 200 or 400 basis points if you're just looking at the private credit space, right? What are some of the key selection criteria that investors should look at when they want to decide which manager they should partner with? Or put it in other words, why should someone come and look at a modulus compared to, let's say, an ABC or a DEF?
Now, again, a very interesting question. So, if you look at today's on a broad brush in the landscape in India today, in terms of all the credit funds that are generally there, I would broadly divide them into three buckets: performing, special sits, and distressed. Now, in absence of a regulatory definition of what these funds, their actual meanings are, but performing credits are generally companies which are established, which are around for a long time. They've established business models, and they're generally, running and profitable companies. I think that's fundamentally what you call performing risk. As Modulus, we are in performing credit category. Moving on, and accordingly, as you move up the chain, obviously your risk factors increase. So, for example, the second category is really the special situations category, which how we define is really where the exits are really predicated on a occurrence of an event, etc. So obviously, there is a heightened risk, and accordingly, the risk is then, the returns are obviously higher as well. Similarly, there's a third category which we call normally as the distressed sort of a category where the underlying companies are much more coming out of a turnaround sort of a situations. And again, as I explained, I think it's sort of higher risk, higher return. But from a modular standpoint, I think, and then there are funds across these categories. So one is that from an investor standpoint, I think they should understand the risk of each sub-segment carefully. Second is while deciding on the manager within the sub-segment, I think it's important to understand that, what has been the track record and performance of the underlying manager. What is the core investment philosophy? So from a track record and performance, from a modular standpoint, we have done fund one. Now we are doing fund two. In fund one, we deployed about 1,800 odd crores. In fund two, we are already 600 crores plus. In fund one, we have already returned significant amount of capital back, about closer to 1,100 odd crores out of 18. And I think, our track record and performance has been between 13 to 14% on a post-expense pre-tax basis. So fundamentally, the track record and performance is a very important criteria when we sort of select a manager. Second is that, what we believe in articulation of your investment thesis. What do you actually mean by performing credits? What type of credits do you actually pick up? And, how we sort of, something that you've sort of explained to the investors while anchoring the capital is something that also comes out when you actually make those investments. So, for example, is it a sectoral play? For example, we don't do real estate in the funds. Is it very sector agnostic? Is it something that, what sort of collaterals do you take? How do you monitor your risk? And, do you take board positions, or this very passive lending, etc.? So some of those investment philosophy is something that should be very carefully articulated. Third is, I think, how strongly you monitor your underlyings. What's the transparency and disclosure levels? How do you communicate to investors at the end of every quarter or every periodicity? What investments have you made? Why this investment was made? What was the broader philosophy around it? And how is it performing? I think that's also very critical. So broadly, I think these are the three sort of factors. And in addition to it, probably the last pillar is really about the team. So I think the consistency of the team, the past experience of the team, in terms of not only making investments but managing exits, working through the exits. I think these things are very, very critical. while you select a manager. So from a modulus, as I explained, we are in a performing credit category, and I think we are on fund two, as I said, and our performance has been pretty much consistent over the last 6 odd years that we have been managing this capital.
Okay, great. And Raksha, just final piece of question, more from a macro top-down perspective. Today, we are at the peak of the interest rate cycle. Someone who's probably looking to, let's say, invest in a public market counterpart and play the capital gain, they could very well do that, right? Why is private credit today positioned perfectly in the context of where we are with respect to where the interest rates are and how it could potentially be in the next 12 to 18 months?
See, I think if you look at, there isn't a better time to invest in bonds, what we are experiencing now. So, from an India context, I think we are broadly at we have sort of done with the rate hikes, and we have peaked out from a rate capacity. We've sort of the global commentary from a macro perspective also, that I think all the rate hikes, etc., have all been done away with. And I think now at one point of time, whenever the markets are right, it is all when the data is to the respective economies are right. I think that pivot to reversal of rates will sort of begin. So I think we are at a point of time in India today where we are at an elevated interest rate cycle. I think, and I think anything that you sort of invest today in bonds and in fixed income on a downward slope when the interest rates go down, it's whatever time period that we have, 12, 18 months, I think there is money to be made. So it's no brainer that, at this point of time, one should sort of invest in bonds and have a higher fixed income allocation. Second is, I think from an asset allocation strategy also, I think fixed income deserves a fair bit of attention. While of course equity markets are doing well, but I think I've always advocated asset allocations to investors. See, fixed income is also the third aspect is that if you're looking for a consistency of income, if you're looking at a income distribution product, if you're looking at sort of beating inflation two times, over a longer horizon of 5, 10 year period, I think fixed income, in my opinion, sort of comes right at the top. So I think to that extent that it's very, very macro supported at this point of time. So I think there isn't a better time to invest in credit funds, what we are seeing today.
Great, Rakshat. I think this was extremely helpful for our audience. Just very quickly, it gave them a good understanding of what private credit, performing credit space is, what Modulus is doing differently from other credit managers in managing credit investments in a tough market like India. So just want to summarize today to all our viewers and listeners. Yes, private credit, performing credit is a specialized form of lending best done by focused alternative asset managers who understands the credit market in India really well, does tight structuring, and this definitely deserves a certain percentage of your portfolio, depending on again what your financial goals are, what your overall portfolio size is. So do not directly look at let's say this as a product compared to equity market returns, which have obviously given stellar returns. These are two completely different products where this is more focused on the stability, predictability, and consistency of returns, which is something which is difficult to find from equity markets. Both of them have their own place in their portfolios. So this is a product that obviously requires a certain amount of sophistication, certain amount of understanding, which you're not able to find in the public markets where the credit risk effectively have been taken away after the 2020 market developments, specifically with respect to one fund house. So I want to once again thank Rakshat for joining us on our podcast today, and to all our viewers, listeners, and our clients. If you would like to hear more, please feel free to give us a thumbs up on the YouTube channel and give us a comment or a like down below. Thank you, Rakshat, and we look forward to having you once again on our show in the near future.
Thank you, Varun, and thanks for having me over.